Okay, last discussion on money supply and inflation, and maybe some actionable items here. So when we look at the charts, remember we looked at this chart about consumer price index and monetary supply, it just doesn't correlate. We thought that probably that relates to consumer behavior more than anything. People are busy, they don't change their buying behavior just because they have more money. But the money has to go somewhere, so that's a viable question, right? Where does it go? Where does that money go? And then you see the second chart, we talked about GDP to consumer price index to money supply. Well, maybe that money goes into the GDP and cycles in some other way, so we can see GDP correlate to money supply pretty much directly. And then we talked about money supply in general. Our low interest rates today, we probably are undersupplied on money anyway. Maybe we're still undersupplied. Interest rates haven't shot way up, right? So probably still need more money supply. And then I want to show you the chart that probably says it all about consumer behavior. If you look at this change, year-over-year change in money supply and velocity and inflation, you'll see the consumer price index bounce between these two lines with no correlation, just none. But you'll see the money supply and velocity directly correlate. So basically, you put more money in the economy, you get less turnover of that money because consumer behavior doesn't change. So if people are buying the same things, but there's more money in the economy, then inherently the money is turning over less often. If these correlated and the turnover matched the supply, well, then you'd have dramatic inflation, right? But it turns out it's a butterfly image. It directly offsets. So money supply just doesn't drive inflation. But let me show you the next chart. What it does drive, well, let me show you the next chart on velocity, and you can see it in a very short picture. It's directly related. You can see this money velocity collapse when money supply goes up, right? So this last chart is where inflation does show up. And here you can see a pattern. Money supply goes up, and guess what goes up? Investable assets. Here it's showing the S&P 500. We know that land and houses, those kinds of hard assets are going up in value. So extra cash in the system does not change consumer behavior. It just gives us extra money to invest in the economy, invest in infrastructure, which is why GDP grows, and invest in stocks and bonds and real estate and hard assets. So on this S&P PE ratios to money supply, you see these companies earning more and their PE ratios going up, the price earnings is going up as the money supply grows. This is a direct correlation to the equity market. So equity market inflation happens when people have extra money to buy those stocks, a lot of money chasing very few investment opportunities. So we talked in a previous video about 1920 and the run after 1920, the roaring 20s. Money supply kicked up in 1920 to offset that pandemic, and the prediction is it will happen again here, right? All assets, not just public equities. Private companies should see inflation in their valuations. You'll see inflation in real estate prices, which we've already kind of seen, and you'll see that continue on for a good number of years. I mean, a good number of years. So I hope that's helpful.